Hey, welcome back to Everyday Economics. This is the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug. I'm publisher of the Center Square Newswire. Everyday Economics is brought to you by the Center Square. You can support Everyday Economics by making a tax-deductible charitable contribution by clicking the link in the show description. We are recording this episode on a rare Monday. This is new territory for us. Monday, May 19th, 2025. Joining me as always, my friend and colleague, Dr. Orphe Divounguy. He's a PhD economist and pretty smart dude. He has a column every Monday on the Center Square Newswire. You can probably read it in your hometown paper if you are not so lucky as to have a republishing partner in your market. You could read it at thecentersquare.com. Dr. O, this week it's all about the housing market. Are you qualified to talk about the housing market? Is that something
man,
you have any? Do you have any familiarity in that space?
man, I don't know. I mean, I tell people, look, I live and breathe housing. I'm the kind of guy that watches housing TV shows, looks at housing on Zillow, and then wants to take my kids to open houses every chance we get. So yeah, I think I might be just a little bit qualified.
That's a whole level of nerddom right there. All right, so hey, so the headline on your column this week, and there isn't a tremendous amount of market data to come out. Normally, you'd look at sort of what's coming in the week ahead. There's really, as we're sort of cruising into Memorial Day weekend, there's not really a whole lot going on here in what would be the last full week of May. But the housing market takes center stage this week. Recent economic data hints at a slowdown ahead. And you go into, just some numbers. It's like a power-packed lead. Last week's consumer price index for April showed inflation ticking up slightly after March's decline. Headline CPI rose 0.2% in April, accelerating from the 0.05% decrease in March, while core CPI also increased by 0.2%, up from March's modest 0.06% increase. On a year-over-year basis, headline inflation edged down to 2.3% from 2.4%, but core inflation remained stubborn at 2.8% for the second consecutive month. It's a lot of data points in a lead, a lot of numbers, sort of to get your story going. What does it mean? I mean, what are you trying to say there?
We had a big plunge in March. Prices actually declined, slightly in March. Slight uptick. Everything looks pretty good on a year-over-year basis. Inflation still moving lower. It just means inflation still going in the right direction, right? Which is lower. People want to see inflation go lower. It's going lower. I think that's great. So I touched on that, and I touched on that because of all of the fears that surround the economy and the headlines today. People are talking about stagflation. People are talking about there's this fear that potentially the U.S. economy could be slowing, and as it slows, unfortunately, price growth could remain elevated due to tariffs. That's the fear, right? And of course, if we have high elevated inflation with a cooling economy, the Fed would not be able to step in to rescue the economy, right? Because of course, it would worry about reheating inflation, right? And so causing inflation to increase. And so that's the fear that's out there. But I think that fear is misguided. And here's why.
Let's talk about that. Let's talk about that. Why do you think that
this whole stagflation thing is a little bit misguided? I think what we're going to have is a initial firming up of inflation, but that is likely to be temporary. And the reason it's going to be temporary is because, look, the consumer just doesn't have it in him or her to go out and spend more. Consumers are starting to pull back a little bit. They're not sitting on the record savings that they had during the pandemic. They don't have those checks coming from the federal government anymore, right? So, and at the same time, you have some government reduction in employee and payroll. You really have major headwinds in terms of the consumer's budget constraint, and so aggregate demand is likely to slow. Businesses faced with higher costs are not going to be able to protect their profit margins by passing on the higher cost to consumers, which essentially means they're likely to cut workers, right? Lay off some workers in order to protect those profit margins. All of that is hinting at an economy that's likely to slow, with both the unemployment rate rising, but also the price pressures, the slowing in aggregate demand negating or offsetting the initial price pressure that we may actually see from the tariffs. So I just don't see inflation coming back, roaring back like we saw in 2021.
Mm-hmm.
And essentially, and by the way, and essentially, what does that mean? What that means, the Fed's likely to cut, right? So I see a lot of people are like, oh well, yeah, I think if the economy continues to slow, the unemployment rate continues to move slightly and higher, the Fed will eventually have to cut.
Well,
The markets
let's
the
talk about
market
that.
expects two cuts this year, down from three, and the only reason it's down from three is because the administration pulled back on tariffs a little bit, right? It was so bad we were going to have more rate cuts than less, right? And so the fact that we potentially could have averted disaster means the Fed is probably not going to have to cut as much as it would have just when tariffs were where they were a couple weeks ago.
All right. So for people that are kind of hanging out waiting for interest rates to change, whether they're buying a new car, they're buying a new house, making a big purchase, I mean, I hear this from people, like sort of waiting out the market. They might
I
be
still think
getting.
that's a wrong idea. I
I know,
think,
I know you're absolutely on the other side of that fence,
yeah,
and yeah,
and
but
I'll give you one example, Chris. Remember in August of last year when the Fed started cutting, everybody expected that the Fed rate cuts, were going to
yes,
cause our mortgage rates to go down and all that stuff.
yes,
By October, November, rates were actually higher than they were before the rate cuts. In August and September. So, waiting for Fed to cut interest rates is not the right way to do it. The Fed really controls short-term interest rates, not long-run interest rates, right? Like your 10-year Treasury, basically the benchmark Treasury yield that basically kind of controls or leads, the rates that banks lend to you at, essentially. And
yeah.
so I think that's misguided too. Don't sit there and wait for the long Treasury yields to go down.
Well, we always appreciate advice from Uncle Orphe, but my question is, the Fed is likely gonna cut in June. Is it a quarter? Is it half? Would they have to do anything significant? I mean, I don't believe last year. Correct me if I'm wrong. Of the cuts that we did get, that they cut more than did they? Was there a half point cut at any juncture last year, or was it all quarters?
I think we did have the first one. Wasn't the first one a half point cut?
It might have been.
Fed chair panicked a little bit. The
Yeah,
economy was going really
right,
fast.
yeah, right, because he was a little behind the curve. So if we do get a cut in June, after the Fed gets together, are you thinking that we're going to get a quarter point, or are we going to get a
Yeah,
half
I
point?
don't think. I mean, the market right now anticipates a cut in September. First cut in September. We're not cutting until September, at least according to market pricing right now. And if we're lucky, we get another rate cut in December.
Does that feel like forever? However, based on the way that the sort of the market is moving, I mean, certainly the Trump administration has been asking for, a cut. I think pretty much since day one. Um, you really do think that it's gonna be September before we'd see any activity?
I don't think so, actually. All it takes is a little bit more disinflation and the unemployment rate to start ticking a little bit higher.
Yeah,
Right now, right now, first of all, the inflation picture looks good still. I think the worry is that with tariffs and the drying up of shipping from China, you could potentially get some price pressure during the summer, right, and in the months ahead, especially around the holiday season, July. Um, But yeah, the pressure might come a little bit, but it's going to dissipate really rapidly. So I think that's what the Fed's just waiting for. They wanted to see how it would play out. Also, the other thing is the tariffs are not gone, right? They're not gone. They're paused. That's another problem. So
Well,
ultimately,
we're gonna talk about that in the next episode. So hold your
if the
thought there.
administration was trying to cut, if the administration really wanted rate cuts, the I don't know if the pause is helping them, right? Because the Fed's like, hey, we're just going to wait and see what happens. I think that the administration needs to make a decision what it wants to do in terms of fiscal policy, and just go with it, right? With whatever it is they have in mind. That way, the Fed can actually react. Right now, there's just so much uncertainty. Yes, peak policy uncertainty is behind us, but there's still so much uncertainty when you're trying to forecast where the economy is going. And so you want to know where the Fed is going. Well, Washington needs to make up its mind first.
Well, we're going to bring it back and we're going to talk about that. So let's call it good for now. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics wherever you get your podcasts. Make sure you listen to us each week on the Center Square Radio Hour. And don't forget about Orphe's column, Everyday Economics, every Monday at thecentersquare.com.